How is everybody doing? Welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. Today, I wanted to bring everybody an episode on a really critical topic in the banking industry right now, and that is the concept of extend and pretend. What does that mean, and what are kind of the ramifications of that? I found a great paper that was published from the Federal Reserve Bank of New York on this whole topic, and I wanted to bring that in and share that with everybody. So this is the Federal Reserve Bank of New York website, and you can see here the report here. So this is a staff report that was titled "Extend and Pretend in the U.S. Commercial Real Estate Market." And so what we're going to do is, because this is really written as more of a, I would describe it in the sense, this is written more as an academic paper, and it really breaks down is more almost like a peer-reviewed type periodical paper. So I'm going to kind of skip through a lot of the front. I just want to get down to the meat kind of at the end of the paper, but I want to give everybody, just want to read the abstract because I want to give everybody kind of a sense of what this is. So in this paper, so basically it says, we show that banks extended and pretended their impaired commercial real estate mortgages in the post-pandemic period to avoid writing off their capital, leading to credit misallocation and a buildup of financial fragility. We detect this behavior using low-level supervisory data on maturity extensions, bank assessment of credit risk, and realized defaults for loans to property owners and REITs. Extend and pretend crowds out new credit provisions, leading to a 4.8 to 5.3% drop in CRE mortgage origination since 2022 quarter one, and fuels the amount of CRE mortgage maturity in the near term. As of 2023 quarter four, this maturity wall represents 27% of bank capital. Now, I have reported on this in past issues, this idea of extend and pretend. So in other words, what is this? So on the commercial side of banking, it is very typical for loans to have maturities that are 3 years, 5 years, 7 years, 10 years, much shorter than, say, like your 30-year fixed rate mortgage. On the commercial side, because you have to worry about credit risk, you have to worry about interest rate risk. So maturities are a lot shorter to help the bank kind of navigate, the different risks that it has to take into consideration. But interest rates go up, and they spiked up very hard, very fast. It was one of the most aggressive rate increasing cycles that the Federal Reserve has ever had in their 100+ year history. And so as a result of that, banks had booked a lot of commercial loans that were, 3.5%, 4%. And now they came up for renewal, and all of a sudden the rates were at 7%, 7.25, 7.5. And all of a sudden, those interest rate resets that had to be done, they caused cash flow problems. They didn't work. So banks basically just extended the loan. Instead of renewing it, they just extended it. They just pushed it out. Okay, we're going to push it out 6 months, 12 months, 18 months, 2 years. But now, banks are getting at an inflection point where basically they're like, okay, we can't really extend this anymore. It is what it is, and we're going to have to bite the bullet. If anybody's seen some of the episodes that I've pulled out over the last few days on like the CSBS, looked at bank reports. We looked at some of the other OCC reports and different things that are out there right now. But basically, one of the big concerns in the banking industry is credit quality over the next year. And I think this leads into that. Like, this is why banks are concerned about credit quality, because they know that they've got these problems, and they've been pushing it out, hoping that the Federal Reserve would reduce interest rates and basically bail them out. And while the Fed has just started to reduce interest rates, the Fed, stood pat perhaps a lot longer than banks thought that they would. So that has led today. And now, what they're saying here is that now you have this buildup of fragility in the banking system, because a lot of these deals that they extended and pretended on are not going to pan out. They're basically going to go bad. So let's take a look at the full article. So here's the paper itself, and what I wanted to do is I wanted to go down here specifically to page 36, which is basically the implications for financial stability. So the results so far show that weakly capitalized banks have extended and pretended their impaired CRE mortgages since the first quarter of 2022, and that this behavior has crowded out the origination of new CRE and new C&I credits. In this section, we show that this extended pretend behavior has also led to an ever-expanding maturity wall, namely an increasing volume of CRE loans set to mature in the near term, which, as we later argue, represents a meaningful financial stability risk. Figure 6 documents using our loan level CRE data the rapid expansion of the maturity wall from 2020 to 2023. And each line shows for a given year the balanced dollar value of CRE mortgages maturing in each year in the future. So, for example, to produce the fourth quarter of 2022 line, fourth quarter 20, line, the subset, the stock of mortgages outstanding as of this date to find the balances expiring in 23, 24, 25, and so on. So you could see here from this chart, and if I can blow this up a little bit here, make it a little bit better so people can see it. So you can see here from this maturity wall, 24, 25, and we're really going up here. So 25, 26, 27, the next 3 years is when you're going to see the height of this maturity wall. And this is in hundreds of billions. So this is 800 billion right here. And this is 1 trillion. So just to understand and that's why they call it a wall. You can see the way that the chart goes. It's like literally you have to jump over a wall. So this is the maturity wall that they're talking about hitting. And so you've got in 2025, you're going to have almost $800 billion in loans that are going to mature. And then in 26, another probably 800, but probably 900 billion. And then in 27, it's not going to reach its peak until 27, when you're going to have, probably almost about $1 trillion in commercial loans. So effectively you got about 2.5 trillion, something in that neighborhood, 2.5, 2.6 trillion in commercial loan mortgages, commercial loan debt out there that is going to mature in the next 3 years. That is going to be a problem, and it's going to hit hard. So then let's go down now to the conclusion. So the post-pandemic period is characterized by a deterioration of CRE valuations and monetary tightening. In this environment, banks have to manage the CRE loan portfolio while seeing their mark-to-market capital being eroded by losses on securities. In other words, that's the unrealized losses in banks' bond portfolios, another issue I have talked extensively about. We document that since the first quarter of 2022, banks have extended the maturity of their distressed CRE mortgages coming due and pretended that such credit provision was not as risky to avoid further depleting their capital. Consistent with this interpretation, we find that this extend and pretend behavior is driven by banks with weak mark-to-market capitalization. Is absent before the first quarter of 2022 and is also present in bank lending to REITs that hold large CRE portfolios. The effects of this behavior open up several research avenues. On the one hand, the resulting crowding out of new capital provisions slows down the efficient reallocation of CRE credit, likely hindering the downsizing of office districts in urban areas, also affecting cities' tax revenues. On the other hand, maturity extensions somewhat mechanically fuel a rising wave of impaired loans in the future. The materialization of this financial fragility depends on whether banks will be able to deal with rising defaults in an orderly fashion or whether widespread defaults will lead to sudden and extensive losses. Yes, absolutely. So, and then it just, typical, the paper goes into references and all that, but really good. Really good, really interesting paper. I was very happy to kind of see that somebody was doing some research on this and putting it out, because I think it's a very highly important topic. And I was kind of surprised that this paper did not get a little bit more play in kind of the mainstream news, if you will, at least on like CNBC, Bloomberg, that kind of thing. Because this is a critical topic for bank, credit quality, because obviously if credit quality goes into the tank, this will cause, at least a few banks to fail. and it could lead to major issues. And I would be very curious to see if this issue is really extend. I mean, obviously, people really look at the regional banks, right? They look at the large regional banks, banks that are, between 100 billion and probably, I would say, 100 billion and 300 billion in asset size, because obviously from the banks that failed in the we'll call it like the mini crisis in 2023, we only had a couple bank failures in 2023, but they were the second, third, and fourth largest bank failures in U.S. history. First Republic Bank out there in California, Silicon Valley Bank in California, and the Signature Bank in New York. All three of those banks were very large regional banks with over 100 billion in assets. And like I said, they rank as far as like largest bank failures, they ranked 2, 3, and 4. The terms of dollar amounts, 2, 3, and 4 largest bank failures in U.S. history. So, obviously, this is I think this is a big issue for the other regional banks in the U.S. So, how closely do regulators and everything really get on top and really monitoring this, knowing that you have this massive maturity wall and this huge amount of maturities coming in? Or are they just going to kind of hope and pray that basically the Federal Reserve reducing interest rates, that they can reduce interest rates by enough over the next year to make a really big impact? I mean, they're not going to bring the rates back down to 3.5% and 4%. Like, that's not going to happen. But if rates get back down to 5%, obviously 5% is a lot better than 7% or 7.5%. So that in of itself is a huge difference. I think people could probably swallow 5% or 5.25 like that, and that's another thing that could be interesting to look at. What exactly is that break-even point? And I'm sure, and obviously this report came from the Federal Reserve Bank of New York. I'm sure the Fed, either it's some of their different bank, either Cleveland or Philly or New York or St. Louis. I'm sure somebody is taking a look at that and basically going, okay, where is the extend and pretend issue the most prevalent? Is it with smaller banks? Is it with regional banks? Is it with the really largest banks, the big four? Like, who is this issue really prevalent with? And like I said, and I would maintain that it's probably very prevalent at the largest banks, but they probably have the ability to better absorb it given their capital levels and things like that. Whereas at regional banks, with the issues in their bond portfolios and mixing in this credit liquidity issues, this could become I think their danger is that this could become a very toxic brew. And but we'll have to see what happens. But great report. If you get a chance to check this out, I highly recommend it. It's just really good thing. And we are going to keep our eye on this whole notion of extend and pretend, because it is a big issue. It's a major issue, and I'm sure that this thing is going to rear its ugly head here, and over maybe even continuously over the next 3 years. But we shall see what happens. But if you like this episode, please make sure to like, share, and subscribe, as it always helps the channel. Make sure to leave your comments down below, as I always love getting back to everybody. Remember, we are on YouTube, Rumble, and all the major podcast platforms. Please be sure to check out some of the other content on the channel. I put up a lot of great episodes on a lot of different banking-related and finance-related topics. And do not forget, tomorrow night, BND Strategy Room live stream, live on YouTube at 7 p.m. Come on and check it out. I usually go for between about an hour and a half, talk about kind of all the things happening in banking for the week, and give everybody a whole bunch of updates on economic indicators, news, just different things going on. But like I said, if you haven't checked it out, give it a try, see if you like it. So, but until then, I shall see everybody soon. Thanks a lot.